Welcome to the Valuation Masterclass Bootcamp final presentation. We're going to be hearing a valuation report done by one of our students who's graduating on the company FedEx. And I haven't followed FedEx recently, so I'm excited about this, but more importantly, excited to see the excellent work that he's done. So let me just bring him in right now and let's get started. T, are you ready to rock?
Hi, Ms. Andu. Yes, I'm ready.
Okay, I'm going to bring in your presentation and I think we are ready. So I am going to leave the live stream now and then you take over. I'm leaving now.
Hi guys, I'm Thakon Khachitanon. Today I present a high conviction stock idea backed by strong fundamental and clear growth drivers. So I initiate the coverage on FedEx with a buy recommendation based on target price of $213 with an upside of 43%. I derive my target price from a free cash flow to firm methodology using a WACC of 11.1% and terminal growth rate of 1%. And here's some key highlights. Amazon becomes FedEx key strategic partner for volume growth in the short term. Second is riding the e-commerce wave could drive FedEx revenue in the long term. And last one is strategic capital spending fuels long-term efficiency outlook. Let's start with the background of the FedEx. FedEx is a leading American company in the express transportation industry, hold 20% of market share by revenue in 2024. The core revenue derived from offering a range of express transportation services designed for time-definite delivery worldwide, and what FedEx differentiates from UPS and DHL. And also Amazon is multi-network of FedEx, which separate express, ground, and freight operation for enhanced specialization, enable FedEx to excel in time-sensitive international deliveries. And let's start with my highlights. First is Amazon become FedEx key strategic partner for volume growth in the short term. FedEx signed a multi-year agreement with Amazon, while FedEx has not disclosed any revenue estimate from this deal. Assuming this is a 3-year contract that will be ramped up in first quarter of 2026. So as a result, I expect FedEx could see a $5 billion increase in revenue or 6% revenue growth from previous year, with an estimated increase in operating margin of 1% due to delivery large hard-to-handle packages for Amazon and an accretive yield. And second highlight is FedEx ground service account for 40% of total revenue with a significant portion tied to e-commerce shipment. So historically, FedEx ground revenue has closely mirrored US e-commerce trends, and looking ahead, Statista projects an 8% annual growth rate of US e-commerce from 2025 to 2029, which is expected to drive FedEx ground revenue upward. So I estimate FedEx revenue to grow at an average rate of 2% over the next 5 years. And last one is strategic capital spending fuels long-term efficiency outlook. I estimate FedEx capital expenditure to slightly recover with 5% growth in 2025. I also expect an average growth rate of 4 to 5% growth 2029. This forecast is based on the assumption that FedEx management aim to reduce capital intensity by keeping capex below 6.5% of revenue. Now let's go to the industry analysis. Global transportation market growth and key players. The global transportation industry is expected to nearly double by 2034 in terms of revenue, growing at a CAGR of 8% driven by e-commerce, infrastructure upgrades, and supply chain evolution. As you can see from the graph, DHL, UPS, and FedEx each hold a 21% market share in the courier segment based on revenue in 2024. FedEx is well positioned to benefit from those trends, grow its scale, strong capital, and global expansion strategy as scale and agility become key competitive advantage. And next one is electric and autonomous vehicles reshape the future of transportation. Technological innovation and sustainability are transforming transport. The shift to electric vehicle or EV is accelerating due to regulation, lower oil price, and tech advancement. So FedEx is transitioning in its fleet to EV to meet decarbonization goals and improve efficiency. And last one is innovation is crucial for transportation resilience amid geopolitical and economic challenge. The global logistics market is projected to grow in terms of revenue at CAGR of 9% driven largely by technological advancements such as AI, Internet of Things, and automation. Now, here's a latest quarterly result. As we can see that operating profit increased 11% in the third quarter of 2025 due to a continued saving related to the DRIVE program, which is a cost-saving program through operation automation and improved efficiency. And let's go to the consensus estimate. Over 65% of analysts have buy and strong buy views on FedEx. The mean target price indicates a potential 26% upside. For the revenue structure, FedEx have three main revenue segments, which are Express segment contribute 47% of total revenue. It is the largest part of total revenue. It includes shipping service for the delivery of packages and freight. And next is ground service. Ground segment is contributing 9% of total revenue. It offers the certain delivery to business in the US and Canada. And the last one is freight. It contributes 10%. It provides less than truckload or LTL freight services. In geopolitically, FedEx revenue is distributed by 72% of United States and the rest 28% of international market. Now let's go to here's the FMI investing. FedEx appears to be less attractive, even though the company has high asset turnover and high return on equity while trading at a low price to book. The share price and revenue growth have not delivered convincing results. For the world-class benchmarking, overall profitable growth consistently rank average, resulting from profitability and from asset efficiency and expense control that are ranked quite stable on average. Nevertheless, the key drag is revenue growth. And here's a profit and loss statement. Revenue, as you can see that revenue and earning per share still deliver growth in the future. For total assets still growing aligned with total revenue, but at lower growth rate as a result from a lower estimated capital expenditure. And for the liabilities and equity, I estimate long-term debt to have low growth, while we can see that the book value per share expect to be higher in the future, resulting from higher retained earning. And here's a cash flow. We can see that capex that I mentioned earlier, I expect it to be roughly 6% of the total revenue compared to the historical ratio of 7%. For the ratio, the cash conversion cycle remains stable in the future. And we can see that the net profit margin, asset turnover, and leverage ratio are quite stable, which contribute to a stable return on equity for past years and in the forecasted years. And for the free cash flow data, which is important data, for the past 3 years, FedEx generate free cash flow to firm in the range of $7 to $8 billion, while I forecast the free cash flow to firm in the next 5 years to be a bit higher, mainly due to the lower in capital expenditure. And here is a justified price to book relative valuation, which shows that FedEx looks cheap. I forecast its return on equity to be around 60% in 2026, which is in line with the global. And also, this result in a FedEx trading at a significant premium based on 2026 price to book to ROE multiple, which shows that it is highly undervalued. And for the PE to growth, FedEx trade at a significant discount, and it seems very cheap on a PE basis, trading at a PE of 10 times. As a result, FedEx is trading at a significant discount based on the PE to growth multiple compared to other companies in the world. And here's a valuation and target price. I assume a risk-free rate of 4% given the current interest rate to fall and a market equity risk premium for the US market of 10%. FedEx has been a high beta stock for the past 10 years, so I assume a beta of 1.05, which is in line with its previous average, resulting in a cost of equity of 14.5%. I forecast a capital structure with 30% debt to total capital. This result in WCC of 11%. I use a terminal growth rate of 1% and the free cash flow to firm methods and use a free cash flow to firm method. Since FedEx has a stable capital structure and it makes comparing to other companies easier even if they have different capital structure. In my best case scenario, I anticipate a gross margin of 64%, leading to a value of $313 per share based on the free cash flow to firm methodology. This represents a 43% upside compared to the current market price. And let's go to the sensitivity analysis. The optimistic case assumes a gross margin of 65%, 1% increase from my base case, resulting in a target price of $326, which is an additional 5% in upside from the base case. Conversely, in the pessimistic case, the gross margin is assumed to be 63%, yielding value of $300 per share, or 7% decline in the upside from the base case. And here's let's go to the risk. Riding the Amazon wave, but for how long? FedEx may face a sharp decline if the agreement doesn't renew after it ends in the next 3 years. Next is FedEx performance is closely tied to global trade and economic activity. A weaker economy could reduce express and ground package volume, and also along with a shift in international trade, policies such as tariff, export restriction, or sanction may significantly reduce global shipping volumes. And last one is the freight spin-off plan must be on schedule. Management is progressing with the planned spin-off of the less than truckload business target for mid-2026. However, a delay or inefficiency in executing this separation could pose downside risk to FedEx valuation. Now, let's wrap up. I recommend buy on FedEx with an target price of $313, implying an upside of 43% using FCFF method. I believe there is an upside for the valuation by agreement with Amazon, while I recognize the long-term potential in e-commerce trend. However, I do acknowledge that there is a downside risk in international trade and tariff concern, which could negatively affect growth and volume for FedEx.
Excellent. Okay, so let's look at one of the things I want to look at in relation to this is the share price has come down so much. And can you just talk a little bit about what brought the share price down from a high of about 310 down to about, let's say, a low of 210? Now it's up to 220. Talk a little bit about why the share price fell and what you think would be the catalyst going forward.
Okay, the first reason that drives the shares price down is the concern on the international trade or tariff, and also another reason is the increase in oil price. That is the main cause of the FedEx. And I would say if the trade tension is if investor doesn't concern much about the trade tension, the share price might revise up a little bit.
And one of the questions that we got, which was, what do you think about FedEx Drive, thing that they're doing? Can it achieve what the company's saying? Its Drive initiative.
According to the latest MD&A, the management already explained that the drive goal has been achieved, and I also think that in the future this program also gonna improve the EBIT margin of the company by about 1% at the end of 2029.
Okay. And another question that came from Patsagon was about, would the agreement with Amazon affect revenue a lot to compete, let's say, to UPS, or is it a small impact?
Yes, it compared to the UPS agreement, it kind of smaller in terms of revenue, but with an increase in EBIT, since the company used this agreement to deliver the hard to carry for Amazon. So the operation margin gonna be improved a little bit.
Okay, we got another question from Olu Watobi. Says, how does capital spending fuel long-term efficiency when they are considering reducing their capex to about 6.5% of total revenue? Won't this affect growth in the long term and for innovation? So maybe just talk about the capex, because we also had a question from Momin, which was, is the capex too low, or what are your thoughts about your capex assumption? Maybe you can click up and go to the free cash flow table so we can see your capex. Or down, yeah. Yep. Okay, so talk to us about your capex assumptions.
Let's say that the capex in each year got to be around 6%, less than 6.5% to total revenue. So for my estimation, the capex should be at this level, should be around at this level. And I expect the in the following year, the capex would mainly focus on the drive initiate to end in 2029.
I mean, basically, your capex assumption is kind of flat, right, compared to the last couple of years. So there's no major increase in capex there.
I don't think there will be another major capex anymore because as I read, as I do the research, I see that the company has a lot of airplanes that are not operate yet, so they keep it. So I don't think they're gonna put a lot of capex anymore.
Okay. And another question is, Moman is asking, I see that big players like Amazon starting to build up their own delivery fleet. Could that hurt FedEx in the long run? Maybe you can just talk about the kind of the disruptive competition that they're facing.
I would say it's gonna disrupt FedEx, like traditional carrier like FedEx or DHL in the long term, since when the Amazon already ramp up their own logistic company, they don't need the third party like FedEx and DHL or UPS anymore. They can do their own delivery. Yeah.
So why should we buy FedEx when it's got that, difficult situation that it's going to be facing?
Because even they have a long-term risk like that, the company still have 40% upside. And I don't think the company, even the company have this level of growth of revenue growth at 1 or 2%, the company still undervalue a lot.
Okay. Yeah, I mean, when I came up with these companies to do in this latest boot camp, we were looking for some ones that we thought were relatively cheap. So this is definitely one of them. So how does it feel to graduate from the Valuation Masterclass boot camp?
I feel excellent. I has been transformed by you and your team and my team also.
Tell me more about your transformation.
At first, before I joined this camp, I trapped in the complex financial theory, which I cannot use it in practice, and I don't know how to use it. So after joining this boot camp in 6 weeks boot camp, it transformed me how to do it in a real world experience from you and your team and Mr. Moment.
And was that what you expected when you went in, or was it the same as what you expected, less or more than what you expected?
This is more than I expected. Absolutely, it is a lot more than I expected.
And how do you think that that's going to benefit you in the future with your career?
I think this is going to be the foundation that I can start my career like investment banker or investment analyst. With this foundation, I can do any investing job.
Doesn't it feel great to know that you've looked at, the concept of valuation from every angle? So if you were to go in and work somewhere, you would immediately understand mistakes that they're making or where opportunities lie. How does that feel?
Yeah, I think before I joined this bootcamp, I already work as an analyst, and after I joined it, during the camp, you teach me a lot of what I been cross all the time. So that's a lot of things that I get, but I didn't get it when I work as an analyst.
Yeah. We did have one of our upcoming students who also graduated in the past, Lee Rigglesworth. He asked, by spinning off FedEx Freight, do you view this as positive, like unlocking more shareholder value, or do you view it as negative?
I view it as positive. So the company can focus more on the ground and express business. And then there will be another company, which is a less than truckload or the freight company that is gonna trade in the stock exchange.
Right. Okay. Excellent. Good work. And I will see you in the Slack channel.
Thank you, sir.
Yep. Well, he had a problem with his camera, so you couldn't see him moving around, but that was a great one. And as Lee said, great work, guys. And yeah, that was great presentation. And Lee, we're going to see you doing one of these coming up. So if you want to build a competitive advantage in company valuation so that you just have like total confidence, as you've heard from T as an example there, then join us. In fact, follow this coupon code of BC21 Live. You're going to get $900 off. That's for 7 days from now, or scan the QR code, and we will see you in the boot camp. My name is Andrew Stotz, and I want to challenge you to build a competitive advantage in company valuation.